The meeting was held on a Tuesday evening in the Grange Hall off Route 9, sometime in early April 1980. The folding chairs were filled before 7 o'clock. Men in feed caps and work boots, women who kept the books, a few bankers who drove out from town and sat near the front, like they belonged there. At the front of the room stood two men in clean shirts and new shoes. They represented a company building an ethanol processing plant about 40 miles west. They had slides, they had projections, and they had something most farmers in that county hadn't seen in years: a fixed-price supply contract, 5 years in length, for corn delivered quarterly. The room did not go quiet when they presented it. It went loud. I've thought about that meeting many times since. I wasn't in the room myself, but I knew men who were. And the way they described it, the energy, the noise, the sense that something had finally turned, I understood it completely. Interest rates were already climbing by then. Input costs were up. Land prices had been rising for years, and the debt that came with them. A guaranteed price for corn over 5 years felt like someone had handed you a map in the middle of a fog. His name was Dale Mercer. He farmed about 480 acres, mostly corn and beans, rented half of it, owned the rest free and clear. He'd been farming since his early 20s. Not a large operation by any measure. Not flashy, but he was one of the few men in that county who read everything he signed. Almost everyone in that room was ready to sign. Dale Mercer was not. The contract terms looked straightforward on the surface. The plant would purchase corn at a fixed price, somewhere around $2.90 per bushel at signing, with modest annual escalators. Delivery windows were quarterly. Volume commitments were tied to each farmer's projected yield. The company handled logistics. Farmers got consistency. For a lot of men in that room, consistency was the whole point. Stability is attractive when you've known volatility. When you've watched the spot price swing 90 cents in a season, when your banker is calling in November, asking about December payments, when your wife hasn't stopped worrying since 1977, a number that doesn't move looks like solid ground. The bankers liked it too. Predictable revenue streams made loan servicing projections cleaner. Several lenders in the county were already pre-approving expanded operating loans for farmers who signed. The logic was circular, and it felt sound. If you know what you'll earn, you can borrow against it. If you can borrow, you can plant more. If you plant more, you earn more. The ethanol boom was supposed to make that math work. Dale took the contract home. He sat with it at the kitchen table for 3 evenings. His wife, Margaret, remembered later that he barely spoke during those nights. Just read. Made marks in pencil. Flipped back to pages he'd already read. What he found wasn't hidden. It was just written in the way contracts are written. Language that assumed you wouldn't read it all the way through. The delivery penalty clause was significant. If a farmer missed a quarterly delivery by more than 15% due to drought, equipment failure, low yields, the contract allowed the plant to assess penalties against future payments. Those penalties were not capped. They compounded. The liquidity clause was quieter, but more dangerous. It stated that in the event of a material change in the company's financial condition, the company reserved the right to defer payment for up to 90 days and renegotiate price terms with 30 days written notice. Read that again. The buyer could defer payment for 90 days and renegotiate price with 30 days notice. What that meant, in plain language, was this: if the plant ran into financial trouble, it could stop paying you and then offer you a new, lower price. And your only option was to accept or walk away from a 5-year commitment that you'd already built your operation around. Dale read that clause 4 times. Then he went to bed. He called the company the next morning and asked about the liquidity clause. The representative was polite. He said the language was standard. He said the plant had strong capitalization. He said no one had ever had a problem with that clause in similar agreements. Dale thanked him and declined. The news moved through the county the way news moves in farming communities, through co-ops, through feed stores, through Sunday parking lots. Within 2 weeks, most of his neighbors knew that Dale Mercer had turned down the contract. The reactions were not kind, not hostile exactly, but farmers talk. And the talk was that Dale was being short-sighted, that he was letting fear run his business, that he'd spent too long being small and cautious, and now that something real was available, he was too afraid to take it. I almost signed something similar once. Years earlier, a grain elevator offered a 3-year forward contract that looked clean on paper. I remember standing at the counter, pen in hand, and my wife asking me a question I couldn't answer. What happens if they close? I put the pen down. The other farmers at the elevator that day looked at me like I'd refused free money. Maybe they were right. The elevator didn't close, but I thought about Dale when I made that choice. Not all decisions that look right are wrong just because they feel uncomfortable. By the end of May 1980, the majority of the contract-eligible farmers in the county had signed. Some used the backing contracts to extend lines of credit. Others bought equipment. A few rented additional acres to increase their quarterly commitment volume. Dale kept his operation the same size. He sold on the spot market. He continued reading. The first season confirmed every fear his neighbors had projected onto him. Fall 1980, the spot corn price came in soft. Dale's per bushel return that season was noticeably below the contract price the plant was paying. The math was visible and painful. His neighbors were receiving $2.90 or thereabouts. Dale was selling into a market that had slipped toward $2.50 in some weeks. The contract farmers talked about it at the elevator, at the diner. Some of them were gracious. Most were not. Dale was friendly about it. He nodded and said it had been a good year for them. But in private, the doubt was real. That's what people don't talk about when they tell stories like this one. The uncertainty isn't just economic. It sits in your chest in a different way when you've made a choice that looks wrong for months at a time. You start running the numbers in your head every evening. You ask yourself whether caution was really wisdom or just a different kind of fear. You wonder what you missed. Self-doubt is not weakness. It's evidence that a man is paying attention. Dale was paying attention. He kept watching the plant. By 1981, the ethanol industry was not what it had been in early 1980. The political and policy environment that had encouraged ethanol expansion, federal incentives, fuel blending mandates, was shifting. The Reagan administration that took office in January 1981 was reviewing energy subsidies. Feedstock costs were rising, and the interest rates that farmers had been managing were now reaching historic levels. The prime rate climbed above 18% in 1981. For the farmers who had borrowed to expand, borrowing justified by the security of their supply contracts, the new rate environment was brutal. Their input costs rose. Their loan payments rose. But their contract price was fixed. The upside that had made the contract look attractive was now capped. All the downside was theirs, and the plant was struggling in ways that weren't yet visible from the outside. Ethanol plants of that era operated on thin margins. The economics required consistent feedstock prices, stable energy costs, and reliable credit facilities. By 1981, all three were moving in the wrong direction simultaneously. The plant's lenders were tightening. The company was attempting to refinance its operating line of credit at a time when every bank in the country was reassessing agricultural exposure. The first rumor came through in late 1981. A farmer who delivered in October mentioned that his check had been 4 days late. The plant explained it as a processing delay. It was a small thing, and most people believed the explanation. Dale heard it at the co-op. He wrote it in the margin of his farm ledger. Institutions fall quietly before they fall loudly. I've watched it happen more than once. A delayed check is almost never just a delayed check. Through the winter of 1981 and into 1982, the rumors became more specific. Delivery checks were running late more frequently. The plant began applying the language in the liquidity clause. 90-day deferral notices went out to a small number of farmers in January 1982. The notices were framed as temporary, a short-term cash flow issue. The company was working with its lenders. Everything would stabilize. Risk doesn't disappear. It moves. That's the thing about contracts. They don't make risk vanish. They redistribute it. When Dale read that liquidity clause in 1980, what he understood was that the contract had quietly moved a significant portion of the plant's operating risk onto the farmer. If the plant ran out of money, the farmer stopped getting paid. But the farmer was still legally obligated to keep delivering. That's not a partnership. That's a transfer of liability dressed up in fixed price language. By spring 1982, the deferral notices were going out more broadly. The plant's refinancing had not gone smoothly. Its primary lender, a regional agricultural bank itself under significant pressure, had extended a short-term bridge facility, but at much higher rates. The plant's operating margin collapsed. Management was holding creditors in one hand and suppliers in the other, and beginning to lose grip on both. Some of the contract farmers began consulting lawyers. The contracts were valid. The obligations were real. But the payment deferral clauses gave the plant wide latitude, and the renegotiation language made clear that a forced price reduction was a legal option, not a breach. A few farmers tried to exit the contracts. The exit penalties were steep. Walking away meant forfeiting future payment claims and potentially triggering liability for delivery shortfalls already banked against. Locked in means locked out. Dale's situation in 1982 was different. He was selling on the spot market. He was not getting the contract price. The spot market that year was inconsistent, and he had seasons where he sold below where he would have liked. But he was getting paid. Every transaction settled. No deferral notices, no liquidity clauses, no lawyers. More importantly, he had not expanded his operation based on projected contract income. He had not borrowed against 5 years of guaranteed revenue. His debt load was the same as it had been in 1979. When interest rates climbed, his exposure was limited. He could service what he owed. His neighbors could not say the same. The plant formally announced restructuring in the summer of 1982. It was not a dramatic announcement. A letter went to all contract farmers explaining that the company was working through a formal debt reorganization process. Deliveries should continue. Payments would resume on a modified schedule. A creditors committee had been formed. Most farmers didn't fully understand what that meant until they called their lawyers. What it meant was that the plant's debt had now been formally ranked. Secured creditors, the banks, sat at the top. Contract farmers were somewhere lower. Their claim on payment was real, but it would be satisfied only after the secured creditors were made whole. In a restructuring with limited assets, that often means farmers receive cents on the dollar, or nothing at all for deferred periods. Some farmers in the county had multiple seasons of deferred payments outstanding. When the restructuring was complete, much of that was written down. The foreclosure wave didn't happen all at once. That's not how it works. It happened over 18 months, farm by farm, in the way that quiet things accumulate. A family would miss a loan payment. The bank would call. An extension would be requested, sometimes granted, sometimes not. Machinery would be sold, then an outbuilding. Then the rented acres would be surrendered because there was no cash to plant them. Then, eventually, the bank would move on the owned land. By 1983 and into 1984, the county had seen more farm auctions than anyone could remember. Not all of them were directly caused by the plant's collapse. The 1981 to 82 interest rate environment alone was enough to break operations that had borrowed heavily to expand. But for the farmers who had borrowed specifically against contract income that never arrived, whose cash flow models had been built on payments that were deferred and then reduced, the plant's failure was the proximate cause. The social fabric of that kind of loss is hard to describe without making it sentimental. So I won't. I'll just say that it changes a community. The men who lose their farms don't disappear. They stay, they rent, they work for others, they drive combines for neighbors who kept their land. But something shifts. The confidence that had been in the room in April 1980 doesn't come back quickly. Dale Mercer did not get wealthy from any of this. That needs to be said plainly. He didn't profit from his neighbor's misfortune. He didn't make a spectacular call that turned into a fortune. What he did was preserve optionality in a period when most people around him were locking it away. Over the course of 1983 and 1984, as land was coming to auction, distressed land, priced below what it had sold for 3 years earlier, Dale was in a position to buy. Not because he had excess wealth, but because he had manageable debt, a clean credit line, and cash flow that hadn't been interrupted. He purchased 2 parcels over those 2 years. Neither was a bargain in any dramatic sense. Both were priced below their 1980 peak values, and he paid fair prices for properties that had become available because their previous owners could no longer hold them. By 1986, his owned acreage had roughly doubled from where it stood in 1980, not because he was smarter than his neighbors, because he had stayed liquid when they had not. Flexibility doesn't feel smart until it is. I've thought about the structural lesson in this story for a long time. The ethanol company wasn't a predator. The men in the clean shirts who came to that Grange Hall in April 1980 weren't lying. They believed in what they were building. The contract terms they offered were standard for the industry at the time. The farmers who signed did so rationally, based on the information they had. But the contract had a fundamental asymmetry built into it that most people didn't see or didn't look for. When things went well for the plant, the farmers got a fixed price, stable, predictable, fine. They didn't capture any upside beyond what they'd locked in. When things went poorly for the plant, the farmers were exposed to deferral, renegotiation, and eventual loss, through clauses that had been disclosed but not fully reckoned with. That asymmetry on said limited upside, shared downside, is not necessarily a betrayal. It's just a structure. And structures have consequences. Stability on paper isn't stability in structure. What Dale did in 1980 was not genius. He didn't predict that interest rates would hit 18%, or that the ethanol industry would struggle, or that this particular plant would enter restructuring in 1982. He couldn't have predicted those things. No one could have. What he did was read the contract. And when he read it, he asked a simple question. Who carries the risk here if something goes wrong? The answer was, the farmer. So, he said no. There's a version of this story that ends with Dale being celebrated. I don't think that's honest. The men who signed those contracts weren't fools. They were farmers responding rationally to a decade of volatility, rising costs, and the genuine appeal of predictable income. Many of them were not financially ruined by the plant's collapse. They were damaged, set back, forced to restructure their own situations. Some recovered fully within a few years, and some did not. The difference in most cases was not intelligence, it was leverage. The farmers who had borrowed most heavily against projected contract income, who had extended their debt the furthest based on the guarantee of 5 years of fixed payments, were the most exposed when the payments stopped coming. Leverage amplifies everything. In good years, it accelerates gains. In bad years, it accelerates loss. And the bad years always come eventually. The question is never whether the cycle will turn. The question is what position you're holding when it does. Dale's position when the cycle turned was minimal debt, flexible contracts, operational continuity, and room to make decisions. That's not a dramatic lesson. It doesn't fit on a poster. But it's the lesson that actually saved farms in that county, and in counties like it, across the Midwest in those years. The 1980s farm crisis is well documented now. Historians write about it. Agricultural economists study it. The numbers are available. The foreclosures, the debt levels, the rate environment, the structural changes to American agriculture that followed. But most of what's written focuses on the policy failures, the bank behavior, the macro conditions. What gets lost is the smaller story, the individual farmer, at the kitchen table, reading a contract at midnight, asking a question that nobody else in his community was asking. Who carries the risk? It's a question worth asking about every agreement you sign, every long-term commitment, every time stability is being offered, and you feel the pull of the guaranteed number. Contracts shift risk. They don't erase it. The risk that appears to leave your side of the table has to go somewhere. Understanding where it goes and what happens when the other party can no longer carry it is not pessimism. It's literacy. Dale Mercer farmed into his 70s. He never became a large operation by the standards of modern agriculture. He never made headlines. He sold his land in the early 2000s when his sons had moved on to other lives, and his body was telling him what it tells all farmers eventually. He didn't talk much about 1980. When he did, he didn't take credit for anything. He said he'd just read the paper carefully and didn't like what it said. I think about that kind of quiet clarity more often than I talk about it. Not because it makes for a dramatic story, but because it's the most durable kind of knowledge I've encountered in agriculture. Not the big moves, not the bold bets. The patient reading, the uncomfortable questions, the willingness to stand alone in a room full of people who are certain. Most farms don't fall because of one bad decision. They fall because of locked doors. Commitments made in confidence that leave no room to maneuver when conditions change. Dale kept his doors open. That's all. If stories like this matter to you, the ones that happen quietly, in county halls and kitchen tables before anyone was writing them down, stay with me. There are more of them.